Welcome to our webinar on how to navigate SaaS exits in the AI era. There's so much going on in the world that it's hard to keep up with the pace of what's going on. That's why we take some time off every now and then to think about what's happening and discuss internally with our team and put together some slides to keep you informed, to help you better decisions. So here we are together with Philip, and Shahir is helping us out, tech support on, and in the next 3 quarters or so, we're gonna discuss what's been happening the last few months with SaaS valuations and how AI is affecting that, and how to position yourself as a founder and as an investor. So without further ado, let's jump to it. Can you pull up the deck?
Yep.
So here's the agenda. Oh, no, not yet. Okay, here's the agenda. What we're gonna discuss today. So we're gonna touch on essentially what's happening with AI valuations and how that is affecting SaaS valuations. We'll talk about SaaS segments that are most at risk of being disrupted by AI. We'll talk about how to leverage AI internally to maximize your valuation. We're going to talk about how to sell a SaaS business as AI ready or resilient in the face of AI. And we'll try to understand what SaaS acquirers are thinking about. So we're trying to look at the mindset of SaaS acquirers in today's day and age. So the first thing we wanted to discuss is the stock market, which is always full of timely information. Philip, would you take it?
Yeah. Thanks, and nice seeing everyone at the webinar. I think it's a great combination today of AI and SaaS, and we had before our webinars on SaaS valuation separately and AI valuation separately. So today, kind of trying to put this all together and see how one affects the other. And to start with, we indeed, as we do, looked at the stock market, combining our SaaS index, which is around 70 largest companies in the US mostly, and our AI infrastructure winners. So companies that are in semiconductors, in the cloud, and which are actually building up the infrastructure, and just seeing how they performed since the release of ChatGPT in 2022. And here we notice a massive difference. If the bunch of AI winners are up 365%, then SaaS companies have really been stagnating over the past couple of years. They are much below AI winners. The performance is well below NASDAQ overall. And really, if you think about it, not much changed. Maybe their revenue grew a bit during that 2.5 years. Their multiple decreased a bit, but really, in terms of stock price and valuations, we are where we started. So today we will discuss more about why that is happening, kind of what we are seeing as the way forward. So as we do on every webinar, now we can go to our bullish and bearish case. Yes, and are you bearish or bullish today?
Today, when it comes to evaluations, I'm probably more bullish than bearish. It's hard to value businesses that asymptotically go to infinity, and I think that's the potential. By the way, so here we have a quick poll. We wanted to make this webinar a bit more interactive. So you can click on yes or no, whether you're bullish on SaaS going forward. So my case, is unfortunately bearish when it comes to my portfolio. Also, I do that as well when it comes to SaaS businesses. I think that most SaaS businesses don't have an answer how to find their way in the new AI environment, and they're holding to what worked in the past, but unfortunately it isn't, and cannot work anymore. And changing a business that has been quite successful for a decade or so can be a daunting task, and most people don't do it or do it when it's too late. And this is reflected in the share prices. So I don't see that much would change here. And I'm best case scenario, I think the stock prices will stay stagnant. What about you, Philip?
I'm bullish today, and I want to present the case. I'm looking at the results of the polls. They're almost 50-50, but bullish is winning by a tiny margin, 53% to 47. So I have no responsibility to present the bullish case. And I'd say if I were to do a bullish case, especially looking at this chart where AI infrastructure winners are overperforming so much, and if I were to make a bullish case for SaaS, I'd say I'd probably go from behind and make a bearish case on AI first. Because what a lot of conversation is about right now is that software development is becoming so much cheaper, and it's so easy to make new software. You can vibe code it, you can use Lovable, GitHub Copilot, and so on, just build new SaaS. So that's why the SaaS companies are less valuable. So I think where we are at now is that a lot of people are experimenting with that. A lot of people are trying to build new software with AI. But where we're going to end up in a year or two is that those experiments will end, the bubble will burst. And I think it's almost a consensus now across, economists and professionals that we are in a tiny bit of a bubble with AI. So when that will burst and companies are left with their AI experiments, which are going nowhere, there were some reports a couple of months ago that 80% of AI experiments don't bring value. Maybe those customers will go back to SaaS and say, okay, we tried, it was fun, it works 80% of the time, but let's get to something that has been working for a number of years, and there will be a new SaaS renaissance.
That's a very interesting take. I like this take. I think it resonates with our experience also. That, doing something with AI very quickly is easy. Doing something of value that is robust, that is resilient, that will last the test of time, that's tough. So,
My case is
almost
probably
convinced me.
my case is probably a bit long term, because right now I'd agree that all the attention is at AI, and SaaS is losing the attention, probably losing the dollars as well. So we can go in detail on that, on why they underperform and what we see.
And by the way, if you have any questions as we go through the deck, please feel free to type them in the Q&A box, and then we're gonna take them after the webinar. So how we got here, Philippe? It was going so great. Back in 2011, Mark Andreessen says software is eating the world, and it was eating so well all the way until ChatGPT emerged. But what we realized, and this guy is smart, is that already in 2017, Jensen Huang said AI is going to eat software. And would not occur to me back then. I don't know about you, Philip. But I did not anticipate. But I guess he was much closer to what's going on with the tech. So he knew that already back in 2017. That's quite impressive. So is AI going to eat its software? Our hope is not all software. So we believe not all software is on the menu, although a lot is at risk of being eaten. But we have a few points we'd like to touch on that make some software resilient. So first of all, competitive modes, mainly data, I think. If your business is based either on proprietary data that no one else has access to, or regulation, or some regulatory barriers. So take healthcare, for instance, or energy infrastructure. A lot of such businesses, I think, are safe for now. I mean, 5 to 10 years, let's say. Another thing, what we can observe is that if you have sticky customers, we have low churn, it means that it's quite unlikely that AI is gonna affect the business. On the contrary, sprinkling some AI onto the business, I think can make the business even more sticky. And last but not least, mission critical and technically complex software, because vibe coding is great for simple things. It's disrupting smaller SaaS businesses and smaller tools. Today we noticed, for instance, poor Calendly. We noticed that actually Google launched in Google Calendar a very mature functionality of appointment scheduling. So every now and then incumbents tend to build something on the edges that disrupts a whole category like appointment booking apps. But so long as your business is bulky, it's technically complex, and ideally within a niche, you're safe. I mean, it's still a limited number of companies, but quite many can be comfortable. It doesn't mean they can fall asleep. They have to keep innovating and they have to embrace AI. It's just they're in a more comfortable position. Unfortunately, everyone else is at risk, but we're gonna talk about how to handle it. Yes. So how we got here, part two. What we've seen, I mean, the first thing, and probably most of SaaS companies didn't notice yet or did not pay attention. When AI funding wave started, I think around 2015, but peaked. There was a small peak in 2021, and then a slowdown. People try to assess what's going on, and it has since gone to record heights in 2025. There was a big sentiment shift, and I think attention of customers switched. So they slowly, gradually started experimenting with AI. It was not a big deal, and I think a lot of companies, because of incorporating AI into their tech, they benefited from it. But this was the early sign that the shift is coming. What happened next was the AI agents revolution, and essentially that happened around 2023, 2024. A lot of the SaaS work that you can, I mean, the SaaS functionalities that you would normally expect a vendor to provide to you, and they tend to be replaceable with AI agents, and therefore people reassess their buy or build decisions, because for many companies, and here it's evidenced by what Klarna has been doing, you can just build stuff more cheaply and keep up on a lot of the tech stack that you've been using. And the third stage that we're entering now, and this we expect will be happening over the next 5 years probably. We're gonna see acceleration of SaaS consolidation. So you could have even a small company having 50 or 100 SaaS vendors, but I don't think it's sustainable. I mean, you want to have one big tool, most clients at least, that does a lot of things. And because building software is more cheaply and adding functionalities is easier, I think it's a winner takes all market in which you will have large vendors vying for the biggest share of IT spend of their customers, and trying to capture as much as possible of their attention essentially and of their spend. And this is great probably for most people on this call, on this webinar that are involved in NA. And we're seeing this happening slowly, with more and more large landmark M&A deals happening, like Salesforce, who woke up again. So we're quite bullish on the activity. For individual SaaS businesses, obviously we're bearish, but all in all, I think the ones that survive will be more resilient, stronger, and will emerge more powerful from this consolidation wave. Philip, you have something to add?
Yeah, I think really what we are probably now in somewhere at phase 2, middle of phase 2, in my opinion. I think the sentiment shift has been so pronounced already with all the billion and tens of billion-dollar announcements that are happening every week nowadays of different investments of OpenAI, NVIDIA, Broadcom, Oracle, and so on and so forth. So the replacement of AI agents, it's probably happening. Probably a lot of companies are still experimenting. Maybe they're not quite there yet. But I think that in coming 1 or 2 years, we're going to see more kind of actual confirmation that some SaaS tool got replaced with an AI agent, especially maybe for smaller businesses and for some less mission critical kind of use cases, which we're going to talk about later.
Yeah. Oh, are these the results? The results are in?
The results are in 60 to 40 for bullish and SaaS.
I'm very happy to see that. This is really encouraging. I would be afraid there is a little bit of wishful thinking to it. But also, I mean, I hope this reflects individuals' approach to life, and I hope we manage to assemble here people who are more optimistic, because that's the winning strategy, no matter what.
There is no consensus, so there is a market. I think this is kind of in line with consolidation trend. So some people will continue to buy and some people will be selling.
I mean, when we speak with serial SaaS acquirers, other than them not having an obvious exit scenario, which we identified recently as a big problem, no one is asking themselves what to do next after they've bought all these companies. But I think they make good returns still. And they have good process, and because they also have expertise in turning businesses around, they tend to get a good outcome from these acquisitions.
Yeah.
So long as you're smart, I mean, there's still a lot of money to be made in this space.
Okay, moving on to the growth rates. So what do you see the growth rates margin?
Yes, so this is one of the reasons why I'm not so bullish on this industry. Although it seems it's stabilizing. These are the growth rates year-on-year growth rates by quarter since 2015. SaaS has become a mature or almost mature. I mean, 10%, roughly 10% growth rates, still quite good, but it's not a very sexy industry anymore when it comes to growth rates. And in the next few quarters, we're expecting that growth rates will decline below 10%, which is not that encouraging. And on the next chart, we're seeing that for a unit of growth, you're still paying a lot in EV to revenues. And so valuations are holding strong, but we are expecting a correction, probably that will coincide with the AI bubble bursting. And I don't think, I mean, this optimism in AI is sustainable. And the circular deals that OpenAI is doing with everyone. So eventually it will collapse. I mean, SaaS will probably stay flat in all of this, so long as the AI bubble keeps getting pumped. But when it collapses, probably it will drag everything down with it. So that's what we're seeing in the how growth translates into valuations.
Yes, I think for a set of companies that grow less than 10% or expected to grow less than 10%, the current valuations are still quite good. I would also note that on the private market, probably you wouldn't get this great valuations of 6x revenue for a company growing 10%, and we're seeing more and more SaaS companies valued at EBITDA multiple. And I think not only buyers have that approach to the valuation, but more and more sellers are also kind of coming to terms with the fact that profitability, cash flow generation has become quite important, and they are starting to manage their businesses for that.
Which means end of growth, most likely. And then we'll back to our good old EV to EBITDA multiple, which was supposed to come back, and everyone's probably waiting for it. But I mean, it's for smaller SaaS deals, yes, that is more and more significant. But for larger businesses, still revenue multiples reign supreme.
Okay, so now coming to which SaaS segments we think are most at risk, and which SaaS segments are expected to be disrupted by AI. And when researching and thinking that, we first came out to this great framework by Leonis Capital, which they did for AI applications. And there they tried to understand kind of how likely is that an AI app or AI native SaaS company going to be disrupted by an LLM, and that functionality is going to be in ChatGPT or Gemini or any other LLM. And basically what they're saying that the most at risk is something which is technically simple and horizontal. And that stuff a lot of times just has a very large total addressable market and a lot of users expecting that. So, this is the areas that big tech players are going to be targeting, where they're going to develop new functionalities, and where it's most difficult to have an AI native SaaS or just a regular SaaS. So something like text editing and generation, marketing, copy. We had a company called Jasper, which was a pioneer in that. But then with the release of ChatGPT, it just became a little bit obsolete. Or similarly, some AI translation companies that used AI to develop translation engines now, I don't think anyone would use them because just LLM does this functionality as well. And at the same time, the lowest risk is something which is super specialized, vertical, technically complex, and a lot of times just very small for LLM to target. Yeah, so some specialized healthcare analytics, finance, industrial processes, and so on and so forth. So if you're building an AI native with that characteristics, technically complex, vertical, and it's not likely that, you know, OpenAI or Google gonna start attacking this market. And although this framework was more for AI applications, I think that it applies quite well to SaaS companies as well. So anything which is vertical and complex is at a lower probability of disruption. Anything that is horizontal, easy to replicate, technically simple, can be actually done in Lovable or Copilot in a couple of days. That's probably at a much higher risk, and at the same time, not only higher risk from competition, but also experiencing some pricing push from the customers because those applications are easy. But what we wanted to add here is one more thing that we think is super important for SaaS companies is the question, does a process need to be 100% correct? And I think that's where there'll be a big differentiation between SaaS, which is going to continue, and the SaaS, which will be sticky with the customers, and companies which will need to constantly reinvent themselves, you know, add new AI applications and suffer from competition. So what I'm thinking is that, you know, marketing, sales, customer service segments, all the places where you can be 95% correct in your marketing copy or in your email send or in customer agent interactions. It doesn't matter, you know, if there are a couple of errors there and the cost differences are massive. These segments are more ripe for disruption, and I think they'll have a push in terms of lower pricing just because the customers expect these actions to be much cheaper. And everything where processes need to be 100% correct, I think we'll still have a lot of SaaS applications and a lot of customers not ready or not trusting to have AI embedded in the processes. So if you think about payroll or safety, critical infrastructure, you don't want to have 95% of employees getting the correct salary, or kind of you don't want 95% of balance sheet items correct. So there, I think it will be much lower pressure from AI, and I think those companies can be operated for quite a long time before AI gets there.
Yes. I mean, what we're seeing is that people are much more thorough now in understanding the risks also when it comes, the process has changed for evaluating SaaS acquisitions. There is much more downside risk analysis than before. So it's an interesting time, but I hope this gives you a framework how to position yourself and where to invest your energy. This is we wanted to do something practical. So we wanted to touch on areas where AI makes life easier for SaaS founders, and how embracing AI will help you as a founder to be more productive and as a business to ship faster, ship better code, and ultimately have more satisfied clients and a happier team. To some extent, it's based on our own experience because since a few months, we also started experimenting with our own tech stack. And I mean, it's a case in point. As a consumer of a lot of AI, a lot of SaaS applications, we started building since not long ago our own technology. And but anyway, I mean, everyone will be doing it, and it's good to be up to speed with what's moving the needle for SaaS companies. So to begin with, the most powerful use case we find right now for AI and LLMs, all kinds of LLMs, is product development and basically writing code. So here are a few of the most popular tools that we've seen in this space. So Cursor, GitHub Copilot, Lovable, and Replit. It's very powerful, although some companies are resistant to using it. I think that that's futile. I mean, my approach to AI is that if it can do something right now, probably in half a year or 12 months, it will get there. So the sooner you start incorporating it into your development cycles, the better. And it's imperative to also start retraining people in order to get them proficient and change their habits. So another thing where we see impact is in general operations and finance. Ourselves, we have users of NA10. There's a lot of stuff where manual processes based on Excel have been built and are maintained at a high price point. But there's so much money you can save. So we definitely recommend this as a productivity enhancer. Sales and marketing is what's happening in sales and marketing right now is insane. Basically, with the amount of data that's available and the power of AI, you can profile your customers much better. You can understand them. You can understand their habits much better. And you can micro-target them. Something that for a human to do was impossible until not long ago has become doable. And it would be a shame not to take advantage of it. So we definitely encourage leveraging AI in sales and marketing. And the last point, people and culture and founder productivity. AI is a very powerful tool for as a counsel, as a tool to understand what's happening with people basically and guiding them. And we've seen this as a very powerful tool in how we manage our business and how we stay on the cutting edge, how we educate ourselves, how we understand our customers better. So it's definitely something that every person in business should be embracing. Are there downsides, Philip? I'm sure there are downsides. I'm only looking at positives right now.
I mean, there are definitely downsides in product development, and I think some senior programmers would tell that it's not the best idea to just take the stuff and the code that AI generates and kind of putting it in, and you'll definitely need a second pair of eyes on that. But as a tool that just accelerates development and improves productivity, that's definitely needed. And I think for all the downsides, you're gonna need to take a bit of risk, because here the other risk is that your competitors are gonna be using that, and they're just gonna be more efficient, faster, have better sales and marketing, more efficient processes, and better operations.
I think what another thing is becoming dependent on this. I mean, and eventually, I think there's no way around it. I mean, we will get dependent on AI. That's why probably to counterbalance it, more human interaction, maybe going back to office more often. We see a lot of companies becoming virtual, no one coming to offices anymore. I think it's in the age of AI. I mean, it's great to automate a lot of stuff, and I think a lot of people will benefit. but at the same time, I think building the human connections is becoming more and more important. So embracing AI, yes, but not forgetting about human beings and human connections. So more in person, talking to customers also more, because people see through also a lot. For instance, a lot of marketing communication. I'm tuned to notice AI communication and AI written emails, for instance. And I appreciate more and more when someone makes the effort to write something genuine with their own hands typing on the keyboard. So there has to be a balance in everything, including adopting and leveraging AI.
So what are some moves that AI founders can take?
Yeah. So we divide them into offensive moves and defensive moves. You have to take the defensive moves because the world is changing, whether you do something or not, and you don't want to be left behind. In general, traffic from search engines is declining, so the world is moving towards chat GPTs of this and similar interfaces, and you have to be prepared to thrive in this new environment and optimize your everything really for the new interfaces. And eventually, I mean, it's a question whether we will have websites and UX and whether our AI assistants won't do everything for us, like booking tickets, and buying SaaS for that matter. So you have to pay attention to what's happening and adapt to it. Data is becoming more and more important. So whatever data that you have, there's never enough, and you should try to work hard on protecting it and making sure that that you leverage it in all possible ways, because ultimately that's the only moat that separates you from the other guy who can develop the tool with modern tech stack more cheaply, but just doesn't have the data about user and behavior and about and whatever the data they gave you. And you have to educate. You have to make sure that all your staff is AI literate, at least. And offensive moves, we're basically talking about how to become one of the AI natives rather than a company that is a follower and tries to keep up. No one knows really how to do it, so it's all aspirational. And but in the grand scheme of things, we're moving to a new paradigm, and for every industry, um, for every SaaS business, in essence, you should start with a clean sheet of paper and imagine if you had no legacy code, if you had no legacy customer habits, what would the data flows look like? What problem are you solving, and what's the quickest way to solve it with the new tech? And if that means disrupting your business, well, maybe that's the way forward. So definitely being open-minded, forward-looking, and yeah, starting with a clean sheet of paper to reinvent
Companies those days, and they see more risk in those. Yeah, we also wanted to collect some of the kind of factors that were important for SaaS M&A in the past. Some standard stuff like business size, growth, unit economics, and so on and so forth. And how is that changing in AI era? Kind of what are the new nuances there? And then starting from the business model itself, that SaaS has been a brilliant business model because of the subscription, recurring revenue, and kind of overall the nature of the business is easy to predict and to forecast. You have your KPIs, you have revenue growth, customer acquisition costs, LTM, and it's kind of easy to forecast. Now, the first question I think we'll have from buyers in this AI era is like, can you scale the company in the same way as it was before, where you had number of users and the price, as opposed to value-based pricing? Because nowadays a lot of API tools, for example, from LLMs, are value-based pricing or usage-based pricing, where you pay for a record, for an API call, for number of tokens used. And in that way, SaaS has been different, but I think it will become more and more difficult for companies they don't deliver value and don't deliver calculatable value to survive. And the other point here is a user-based pricing or seat-based pricing that we've seen in the past that may change in the future just because AI is becoming more prevalent. And if you believe that AI will transform white-collar work and there's going to be fewer people working, for example, in customer support, then the business model of selling SaaS by seat just doesn't make sense anymore, because you'll have a decline in user base and you'll need to adapt your business model to something which is oriented more to the value. Then the other factor which has been always important is business size, and it is still important. Larger companies are getting higher valuations, but really now when buyers are looking at AI native companies, we're seeing more and more situations where size doesn't matter that much. And we've seen a lot of companies with 10, 20, 30 people being acquired for billions of dollars by large AI players. So on the one hand, it's kind of a bit less important, but it's also a big threat that a company with 10 people can just develop a competitor to your product in a couple of months. So that's a big risk for the buyers overall.
Yeah. We're also seeing very small businesses trying to sell AI businesses, AI native businesses. And many try to do it prematurely. That's probably also not a strategy. So there has to be a balance here.
Yeah, I think it's a lot of, maybe not, there are a lot of very, very small businesses that are operating AI native businesses, and there are only a few small businesses that got acquired. So I think those examples and headlines are kind of affecting too much the minds of some SaaS founders. So if a really company with 8 people got acquired by Wix, yeah, that's probably a outlier.
Yeah.
Yeah, so the other factor that investors have been loving about SaaS companies is the mode they have. So the product is sticky. Once you integrate it, it's difficult to drop. It has a lot of integrations with different other tools. The switching costs are high, and there was a big focus on feature differentiation. So building a product with most features was a good strategy. So I think now the mindset in AI era is, can AI replicate the software at the fraction of a cost, and are the workflows defensible? So what we've been talking about the vibe coding tools like Lovable and Replit, I think it will be a big part of the due diligence of technology companies, is just trying to see, okay, if I prompt here and there, build a product like this, how close it will come to the actual product. And the further it is, the better it is for a business. The next part, which is also changing a lot in AI era, is the unit economics of SaaS and the predictability of revenue. I think before, for value in a SaaS company, you needed to collect a number of KPIs like churn, revenue retention, customer acquisition cost, LTV. and you could calculate easily going forward what's the revenue going to be, does this business make sense, how much you need to invest in marketing and sales, just based on those numbers. I think those KPIs will become less predictable going forward because your churn may change a lot if the new products are coming to market. Your churn may be good right now, but what if an AI native product comes on the market in 3 years? What if another company solves this problem much cheaper? What if their workflows will be much faster? So I think that investors, when analyzing the KPIs and projecting them forward, are now a bit more careful. And the same goes for customer acquisition cost. What Martin discussed a bit was changing traffic flows on Google and the new way of buying software consulting with LLMs rather than doing Google search or going to some software directory like Capterra or G2. This changes a lot the customer acquisition cost. I think SaaS founders are not new to that because historically there was also a lot of experimentation and some channels work better, some channels work worse. But now everyone will need to be ready for AI overviews and LLM supported product selection. I think a big part of due diligence here will be also checking if your customers are not coming from search engines too much. Is your product showing up in LLM? Are you employing some inbound AI supported marketing because other companies in your niche may be employing that? And overall, I think summing up those 5 points is just more risk in any SaaS companies, where before it was a nice mathematical model where you can put in a number of KPIs and just project them forward. They didn't change too much, or they changed slower. So now there may be some big events, AI reaching new heights, and disrupting your products. That's why the risk is higher, and that's why we're probably going to see valuation drifting lower. Anything to add, Marcin?
I think we can proceed.
Yeah. Yeah, so that's why we had before our SaaS exit readiness dashboard, where you can analyze your business across a number of areas, and in line with the AI era, we added a new AI readiness point where you can also analyze whether your business is ready for AI. And we're going to share this deck after the call, and you can download and get your copy of the dashboard and see how you score on that and how you score on other points if you're preparing for exit. So, do you want to sum it up?
We try to wrap it up, Philip.
Yeah.
Yes. Something that changes so dramatically, it's tough to sum it up. But I think, as shown in this picture, SaaS companies have been dealt a blow from AI, and that the world that is running crazy and finding its new balance. SaaS businesses are not the darlings of investors anymore. But we don't think SaaS has said its last word. So we think that the stronger companies, the companies with the vision, they will embrace this new reality and grow stronger, which is shown in the second image here. That we are seeing. I mean, it might appear as a revolution, but it's part of evolution, really, where we had on-prem back 20 years ago. I mean, we still have on-prem businesses. We're gradually, we've gone through the SaaS world. Now it's going to be all about AI, and SaaS and AI will eventually morph probably into a single category. I don't think AI can live without SaaS, and I don't think SaaS will be viable without AI. So we don't have the roadmap because the world is changing so fast, but you definitely have to keep your eyes open and look for cues as to where the market is heading and how to adapt or sell, because that's the easiest strategy, to sell the business and have someone else deal with the transition. If I were to draw a parallel to on-prem businesses, I mean, probably it was a winning strategy to sell while on-prem was still profitable. It was not a winning strategy to sell during the transition from on-prem to SaaS. Once someone has navigated that, then the value accrues to them again. So this is all happening again. There was a peak SaaS 2 or 3 years ago. Now we're in this process of morphing, where valuations are depressed and will continue to be depressed. Once we emerge from that, it's going to be also again a great time once we have the new breed of SaaS, which has merged with AI. But for now, I mean, we have to deal with this risk aversion, and in the short term, we have to have an answer as sellers or also as investors who report to their LPs. We need to have an answer on how we plan to manage AI risks. So that's it, I guess. Philip, do you have something to add?
Yeah, I think it was a very good analogy with on-premise software, which is still, of course, available, and still a lot of companies do that. So we're going to see those changes probably faster than when on-premise transition to SaaS, but it's still, as with any revolution, be it AI or internet or any other, it's going to take some time.
Yeah, probably less than any previous technology shift. But I hope we've been helpful in navigating this transition. We're happy to answer any questions that you might have. We have a few Q&A questions. If you want to meet us offline or online after this webinar, feel free to reach out. I'm happy to take any questions you might have. Any also participant that would like a free valuation of their business and risk assessment in the light of AI, we'll be happy to do that for you. So please do reach out. And now let's go through the Q&A, I guess, yeah?
Yeah.
Very well. Okay, Philip, you take the first question. How do you define an AI infrastructure winner? From Anthony.
Yeah, I think for AI infrastructure winners, we looked at the companies that are in semiconductor layer. So NVIDIA is doing all the AI chips right now, and the companies which are in the cloud service providers layer. So Amazon Web Services, Google Cloud, Azure, and the respective companies there like Microsoft, Google, and Amazon. Yeah, and I think we had also Meta.
Oracle also. Oracle and Meta.
Oracle, which hasn't been, very big in cloud services, but now is growing, and Meta, which is doing their own open source AI.
Have we seen SaaS multiples trending down? Obviously, there was a huge decline, but before from COVID peaks. But yeah, they are quite stable. Although in the underlying businesses, because they're growing slower, they're not as good. So you could argue that paying the same multiple for a business that's growing slower means that it's a higher multiple, essentially. But what is the current market for small but rapidly growing SaaS companies with revenue less than 5 million? That's a tough question. It's not that easy to answer. I mean, if it's AI native, the market is great, probably. when it comes to SaaS, I mean, you really have to dig down and understand all the things that we talked about. Where is the growth coming from? How sustainable it is? If it has good modes, probably a good valuation. Okay, clearly something we are trying to wrap our heads around also. How do you achieve product visibility in LLMs?
That's quite a difficult question because not many people know still. A lot of articles and books have been written about SEO, but about generative engine optimization, not much. But from what we researched and kind of what we are trying to do is at first you need to be out there in terms of information about your product, should be on your website, it should be in text, it should be easily understandable for an LLM. So if you need to add a couple of pages that describe your product in detail, but wouldn't be read by a person, by a human, because they're too complicated. I mean, you can do that and hide them somewhere on your website, just so LLM knows what your product is about. Another important thing that we heard or seen as important in visibility in LLMs is authority and references. So if you have reputable sources quote you or describe your product, something like Forbes, New York Times, LLMs are more likely these days to cite from reputable sources, just because before they had a big problem with hallucinations. So now it seems they're shifting their engines to kind of more reliability, something reputable and big.
Reddit also is a big thing.
Yeah.
YouTube also. I think these are, I mean, any social media, I think they can be quite powerful. Depending also on what LLM you're using. Because if you want to get into growth, probably posting on X will get you a long way.
And in traditional SEO, of course, something like Google AI overviews will just take stuff from the first page of Google search and redo it, yeah, or summarize it.
Yeah. Okay. We've discussed SaaS. A question from Marek, will we be exploring other sectors that haven't benefited from AI so far, but they likely will? In this angle, probably we will look at IT services, how they are being disrupted and what's the next wave. Otherwise, I think it's too early to tell which sectors will benefit. I mean, probably all will benefit in one way or another. But I think this is a much longer into the future. So probably not there yet to speculate about what's happening to other sectors.
Yes,
but we're all suggestions.
Yeah, I mean, we discussed a bit on our webinar about AI supply chain, value chain, and companies who are already benefiting there. And there we have a bit of a discussion about infrastructure, built out supply chain, all the HVAC, construction, chip companies that are benefiting from that. But I don't think we discussed something kind of who's going to benefit in the future, but they haven't so far.
Yeah. Okay, another interesting question. How important is the rule of 40 for buyers? When was the last time we mentioned the rule of 40 in a discussion? Not many times about it.
I don't remember. Yeah, I don't remember.
Yeah.
I think it's becoming less and less relevant, and it started as a way to compensate profitability. I think nowadays people will be just looking at your unit economics in detail and not use rules of thumb anymore. The market is not as fast as it was, for example, in 2021 when you just needed to.
Very high level. You could ignore the details. Yeah. I mean, the word we use the most probably is churn, because this separates really good companies from the not so good ones. Okay, another question. A lot of questions. Thank you, everyone, for contributing. What about AI-empowered SaaS? That's an interesting question because it can mean a lot of things. It can mean a thin wrapper on ChatGPT. That means probably very little value. It can mean an AI-empowered organization that is moving very fast, and that's great. So it really depends. Probably the more proprietary data you have, and you leverage AI, that's great. If you're using your users' data, you don't have any moat and no lock-in, probably it's not a factor really, whether you're AI empowered or not.
Yeah, I'd say something which is just a resale of GPT was
Okay, another question. What is an appropriate revenue multiple for Rule of 40 SaaS companies? That's a complicated question because that can mean a lot of things. But we can take a look at extremes. If it's a 40% EBITDA company, zero growth, probably we're looking at a 5 to 7 times, let's say, EBITDA multiple. That
yeah.
implies 2 to 3.5 times revenue multiple. That's not bad. Now, if we have a 0% growth company, 40% growth company and 0% EBITDA, then we probably would need to look deeper into unit
Yeah.
economics. Because if the company is not making money, doesn't have a path to profitability. So we would look at churn, most importantly, and then take it from there. Probably the multiple would be similar. I don't think growth matters. If it's sticky, if it's high revenue retention, probably a higher more revenue multiple than the previous company with 40% EBITDA margin. But if the quality isn't that good of the underlying business, it's gonna be smaller. Okay, another question. For the bull amongst us, if AI bubble bursts in coming months, will SaaS valuations become better than they are right now?
I think in short term, no, because everything is correlated on the market. And if the largest companies go down, usually the rule of thumb is that smaller companies go down even more, just because the economy is deteriorating and there is a lot of spending kind of in that ecosystem that drives the smaller SaaS companies as well. But longer term, I mean, I could argue that infrastructure will be a bit cheaper, labor will probably be a bit cheaper if AI companies stop paying millions of dollars to their top researchers. I think maybe only in medium term.
It's very hard to predict, but I think valuations will drop across the board if there's a big turbulence in the market. Amazing. It's been a blast. Thank you everyone for attending. Thank you, Philip and Shahir, for making it happen.
Thank you.
Do we have any final words?
I think good luck to everyone. It's interesting times and a lot of change coming up. So we all need to be flexible and adapt.
Yes. Thank you all.
Thank
We'll
you.
be sharing the recording with everyone.
Goodbye.
Thank you. Bye-bye.